Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letters CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello, and thanks for joining me today on Reverse Mortgage Radio. I'm glad you could be here because we're going to talk about something that can confuse a lot of people. I know you're like, well, reverse mortgages confuse me to begin with. Well, strap your seatbelt on because we're going to dig in deep on why there are two interest rates with reverse mortgages. How in the heck do we have two interest rates, right? Well, we're going to discuss that, and I'm going to dig in deep onto why there's two different rates and how they affect you, how one affects you and one might not, and then vice versa. So let's dig in. Before we can do that, though, you know what? I always do this. I apologize. But let's talk about what a reverse mortgage is. We're talking about the home equity conversion mortgage, the HECM, home equity conversion mortgage. That's the name of the FHA-insured reverse mortgage loan program. FHA stands for Federal Housing Administration, and they fall under the umbrella of HUD, Housing and Urban Development. These are terms that a lot of times I use and I say easily, and a lot of people might not understand exactly what they are. But it's all regulated, heavily regulated by the federal government. Just know that, and is protected that way too. You're protected through that process of this regulation. Okay, I'm not a big fan of regulations, but I think reverse mortgages kind of have it in balance, if that's a good way to say it. I say to have it in balance as far as the amount of regulation versus the amount of flexibility. And because there's this regulation and protections in place, it provides the best program for you, the consumer. There are non-FHA insured loans, and they're great for specific situations. But 95 to 97% of reverse mortgages and the people that use them, the FHA version is the best one. Keep that in mind. And by the way, too, if you have any questions about reverse mortgages as we're digging into this kind of confusing concept, let me know. Give me a call. My number is 303-467-7821. My name is Bruce Simmons. I'm the reverse mortgage manager for American Liberty Mortgage here in Denver. And again, 303-467-7821 is my direct line. You can also reach me online at reversemortgageradio.net. reversemortgageradio.net. You can re-listen to this podcast if you know you have to leave here in a little bit and you want to hear the whole thing. Tune in about the middle of next week is how long it takes for the radio station to get the show to my web guy and for him to upload it to my website and all this stuff. But it's on my website. All like the past 7+ years of my radio shows are on my website. You just keep scrolling back. Got all kinds of blog posts on there. There's video testimonials. You can download my free consumer guide that's on my website as well at reversemortgageradio.net. Go there, check it out. You can also get a free quote. And it's a completely free quote. I don't sell your information. You're not going to get a bunch of calls from other people. You can put in your information. I do not require a social security number, but go ahead and see if a reverse mortgage might make sense for you. Now, just know that the numbers that come up on there are conservative. A lot of times I can do a little bit better than what I quote. Most of the time I could do better than what's quoted on that website, but I'd rather underpromise and overdeliver, right? So let's jump into it. There are indeed two different interest rates on reverse mortgages, and this can confuse a lot of people. Even professionals get confused by these two different rates. And why are there two different rates? Well, we're going to dig into that in just a minute. But first off, in a nutshell, the reverse mortgage it's, like I said, it's backed by the federal government, and the two different rates are called two different things. One is called an expected interest rate. The other is the initial interest rate. And I like to put it this way. Basically, the expected rate is used to calculate how much money you qualify for. The initial rate is the rate you're actually charged on your loan balance once you have the loan in place, whatever that loan balance is. Think of it like a roller coaster ticket. The expected rate is like the ticket price. It determines how many rides, or in this case, how much money you have access to. The higher the rate, the less rides you can buy, right? Because your money doesn't go quite as far. And the way this works is that the higher the expected interest rate is, the less money you qualify for with a reverse mortgage. Now, the initial rate is like the speed of the roller coaster. That's what actually determines your experience once you get on the ride, and the ride of reverse mortgages, right? Basically, the faster you go, or the higher the interest rate is, the faster the interest will accrue on the loan balance. The slower the ride, the slower the interest will accrue on it. Hopefully that makes sense. I do want to touch on the expected rate, though. Let's go back to the expected rate a little bit here. The expected rate, it calculates what's called the principal limit, which is the total amount of money you can qualify for. It's based on the 10-year U.S. Treasury index. So the lower that rate, the more money you qualify for, like we said. The higher the rate, the less money you get. So what causes the rate to go up or down? It's the U.S. Treasury rate. It's the 10-year U.S. Treasury rate. So there's a lot of things that cause that rate to fluctuate. Expectations are probably the biggest. One is the inflation expectation. If people think inflation is going to go up, that can cause the 10-year Treasury index to go up. Let's say, for example, you're going to loan me. Let's say you loan me $100, and you're going to say, Bruce, you have to pay me back in 10 years. And the interest rate is at 2%. Well, hopefully you're thinking the money's going to hold its value over that 10 years. But if you think, hey, wait a minute, 10 years from now, I'm giving up a lot of stuff I could buy with that $100. And I think that $100 might not be worth $100 in 10 years. It might only be worth $90. And if that's the case, you're going to want to charge me at least 10%, probably more, because you're going to want to get more money back 10 years from now when I pay you back. So you're going to want to get $110 back, or $112, or maybe $115 back, because the dollar isn't going to go as far 10 years from now if inflation is high. And that's kind of the way interest rates work. If I, as a lender, am going to loan the U.S. government over the money over the course of 10 years, and I think inflation is going to be high, I'm not going to do it for 3 or 4%. I'm going to want 4, 5, 6, 7%, right? And that's what happens when the expectations of inflation are high. That causes the interest rate to increase because I want to get more money back over time. Now, if the interest rates are low, conversely, the opposite happens, obviously. Interest rates go down. So it's expectations, but also Federal Reserve policy, what the Federal Reserve does, if they can play around with the interest rate. Now, I do want to say real quick that the Federal Reserve does not control interest rates over long terms. They control the overnight rate. And a lot of people think, well, if the Fed lowers the rate, then that's going to change my interest rate. Not necessarily. Although it could go with what the Federal Reserve does. But recent experience shows that it could go the exact opposite. Last September, if you look at the numbers, and I've got this on a chart, actually, you could see on September 16th, when the Federal Reserve lowered interest rates, they lowered it first by 0.5%, September 16th of 2024. Interest rates started shooting up for the 10-year Treasury index. They lowered them again in December, I think, and then again, I think in November and December is what they did. They lowered it in September by 0.5%, 0.25% in November, and 0.25% in December, I think. During that time period, the Federal Reserve lowered their rate, by 1%. That's the overnight rate that banks charge to each other. Our interest rates went up almost the exact opposite. I think it was 0.8% or 0.9% over that same time period. That 2.5 months between September and January 1st, that September 15th or whatever it was, the interest rates on the 10-year Treasury index shot up the exact opposite of what the Federal Reserve did because people were worried about it causing inflation. They thought the Federal Reserve lowered the rate too soon. They didn't think they had inflation under control, and I still don't know whether they do or not. But again, that's expectations. And so a lot of it is what people are expecting. Okay, so that's the expected interest rate. Now, the initial interest rate is what you're actually charged on any money you've borrowed. This is based on a shorter term rate. So this is the 1-year Treasury index. That's what this is based on. The expected rate is the 10-year Treasury index, and the initial rate is the 1-year index. Okay, and then that's what you're charged. It's pretty simple. If you borrow $100,000, you're charged. The interest that's calculated is based on the 1-year Treasury index plus a margin. The margin, some people call it the lender's profit. It's not totally correct, but basically it's whatever the index is plus 1.5 or 2.5 or 3%, whatever it may be. But if you remember back in the day, I think when HELOCs used to be tied to prime rate, that's an index, prime rate, just like the U.S. Treasury is an index. People would say, well, yeah, my interest rate is prime plus 2 or prime plus 3. That plus is the margin. And so that's the way the initial rate works. Obviously, the lower the initial rate, the less interest you're charged on the loan. However, let's not forget about the line of credit. If you have a reverse mortgage that has extra money left over, let's say we qualify you to borrow $200,000, but you say, well, I really only want $100,000. The extra money that's left over that you're not taking can be set aside in a line of credit. And that line of credit has a growth rate to it. That growth rate is the initial interest rate plus 0.5%. So whatever your rate is, you're being charged on the loan plus 0.5%. If you're being charged 6.25% total between the index and the margin, then you're going to be also, the line of credit is going to grow by 6.75. That extra 0.5% is what your line of credit growth rate is. So you're going to have more money if you don't take it all out today than you will later. And if you think about it, it only makes sense basically because the calculations that reverse mortgages use is all based on actuarial data. How long we think you're going to live in the home and what is the expected interest rate. The expected interest rate we already talked about, but how long you're going to be there too. If you're younger, we're expecting that you're going to be in the home a longer time period. Therefore, you're going to be charged interest over a longer time period. The older you are, the more money you qualify for because the interest will not have as much time to accumulate on the loan balance. In other words, if you take out money when you're 90 years old on a reverse mortgage, you might qualify for 60 or 65% of the value of the home because you might only keep that loan for 2 or 3 or 4 or 5 years. Whereas if you're 62, you might only qualify for, say, 32 or 33% of the value of the home because you might keep that loan for 30 years. And over the course of 30 years, a lot of interest can accrue, and therefore your loan balance will be a lot higher. When you borrow the money at 90, just 3 or 4 years down the road, the loan comes due because you pass away or you permanently leave the home. There's not going to be that much extra interest added onto the loan over that short time period. But over 30 years, a lot of interest can be added. So keep all that in mind. That's how the initial interest works. So what does this mean to you? Over time, your loan balance does grow. Like I talked about, the interest gets added to the loan balance, and it affects how much equity you have left in your home. Remember, equity is just the difference between the value of your home minus the loan balance. Right now, if you have a $500,000 value and you owe $100,000 on the loan, you have $400,000 in equity. A lot of people will call me and they'll say, hey, I've got $400,000 in equity and I want to borrow money on a reverse mortgage. And I say, okay, we can loan you 40%, let's say, of the value of your home. Well, they don't listen, and I say the 40% of the value, which would be $200,000 total, but they think 40% of the equity, so they're thinking they could get $160,000 additional above and beyond the value of their home. And anyways, I probably did the math wrong right there. I don't have a calculator handy. But basically, we base it on the value. So if you owe $250,000 on a $500,000 home, you're at 50% of the value is what's owed. If I can only loan you 40% of the value, we have to pay off the existing mortgage. So therefore, I can't loan you enough to pay off your existing mortgage because I can only loan you $200,000, but you owe $250,000. So we can't do the reverse mortgage for you unless you have $50,000 extra you want to bring to closing. And then you pay down, you take the money from the reverse mortgage plus your $50,000, and then we could pay off your existing mortgage. There's no extra money to you, no line of credit, no monthly payment to you or anything of that nature. And you say, well, wait a minute, Bruce, why in the world would somebody pay extra money to get a reverse mortgage? And the reason is to get out of that monthly payment. It's all about cash flow. If you're in retirement, you know cash is king, as far as cash flow is king, I should say, because the amount of money you have coming in every month is very important. It doesn't matter whether you've got $1 million in the bank or $100,000. Obviously, the cash flow that $1 million is going to generate is a lot higher than $150,000. But if you set up things correctly and you're both receiving, say, $5,000 a month, no matter how much money you have in the bank, you get that $5,000. And that's what you want. By paying off and eliminating your mortgage payment, the principal and interest portion of your mortgage payment, because it's still your house, you still have to pay your own property taxes and insurance. You have to maintain the home, live there as your primary residence, and pay your keep your name on title. As long as you do those 5 things, you can never, ever, ever be kicked out of the house and nobody can call the loan due. But you're using the reverse mortgage proceeds to pay off the existing mortgage plus your other money, and that frees up cash, whatever the principal and interest portion of your loan is. If it's $1,500, now you've got an extra $1,500 in cash flow. So that's kind of a little bit off the beaten path that we're talking about here as far as interest rate. But what happens then to the loan balance over time? Because this does involve the interest rate. The amount of interest you're charged on the loan, you're still charged this interest. You just are not required to make a payment every month. What happens to the interest that you're charged? It gets added to the loan balance. That's why the interest rate is important. However, don't forget about the appreciation of your home. Most years, your home is going to appreciate somewhat. Maybe not always 10 or 11 or 15% like it did over the last decade or so, but usually 2 to 4%, mainly 4% is about average over the last 25 years, including the recession where we had so much appreciation or depreciation, I should say, in home values where people lost 20, 30, 40% at times. But even with that factored in, the average has been 4% over the last 25 years. So that's important because your loan balance is going to grow over time. I tell everybody, you're going to get a statement in the mail or you're going to look at it online, and every month you're going to see your loan balance getting bigger and bigger and bigger because the interest and mortgage insurance that you're charged on this loan gets added to the loan balance unless you choose to make a payment, which you do have a choice to do that. But otherwise, the loan balance is going to continue to grow. But remember, the value of your home is also growing. Think of it like two cars on a road. Imagine your loan balance is one car on the road. It's slowly driving uphill, accumulating interest as it goes. But your home value is another car on a parallel road. If the market's good, that car is also climbing. And sometimes it climbs faster, sometimes slower. But think of the home value as a bigger car, because they could technically be growing at the same rate, say 4% or 6%. Even if the one car, your loan balance is going at 6%, and your home value, the other car, which is bigger, is going at 4%. If your home value is $500,000 and it's growing at 4%, that's like $20,000 in that first year that it's grown in equity. You've gained that in just plain old appreciation. If your loan balance is $200,000 and it's 6%, that's $12,000 that gets added to the loan. So the home value car, which is bigger, is growing faster than the other car, which is your loan balance, by $8,000. Hopefully that didn't just totally confuse you. But if you think of it that way, because 4% of 500,000 is a lot more than 6% of 200,000. Okay? Hopefully we're on the same page there. But that's one way to imagine it. Your home value is going up. I got a call from a customer once, and he was telling me that his value or his loan balance was growing faster than he anticipated, which is obvious because he took the loan out in 2020 when rates were at 2%. And it's hard to imagine the rates are going to get back up to 6% or 7% like they did like that in a span of about 18 months. The Federal Reserve just raised rates so fast, and they hadn't done that since the 80s. So a lot of people, it was a shock to a lot of people. But then I pointed out, your home that was worth $360,000 in 2020 was now worth like $500,000. And he's like, oh, well, yeah, I guess I gained more in equity, even though the interest rate shot way up high. And you want to remember that stuff too. And one benefit, we touched on it a little bit, is the line of credit growth rate. If the interest rate you're charged on the loan is higher, the growth rate on your line of credit, assuming you qualify for a line of credit and you have enough money left over to leave money in a line of credit, that's growing fast as well. And that's just increasing the amount of money that you could borrow later. Think of it like a mason jar on your counter. Every month you don't use it, the jar gets a little bit bigger. Okay, that's because the line of credit is growing at the same rate of the interest being charged on your loan plus that 0.5%. This gives you more borrowing power later. The one thing that I hate is when people say, oh yeah, I'm earning 6.5 or 7% on my line of credit. No. You're not earning anything on your line of credit. That just is increasing the amount of money you can borrow later. If your line of credit grows by $20,000 and you pull that $20,000 out, that $20,000 that you take from the line of credit gets added to the loan balance. Your loan balance increases by $20,000 and your line of credit decreases by $20,000. So now you're being charged interest on that $20,000 that you just took out. All right? Keep that in mind. So let's wrap this up here, because basically we've talked about the different interest rates. Remember, here's a pop quiz for you. What is the expected interest rate? The expected interest rate is tied to the 10-year Treasury index, and that's the rate we use to calculate how much money we can loan you. That's like the price for the roller coaster. The lower the rate, the more rides you get to go on the roller coaster, right? The higher the rate, the less rides. So the lower the rate, the more money you get. The higher the rate, the less money you get. And the initial rate is the rate you're charged on the loan balance. That's the speed of the roller coaster. The slower the roller coaster is going, I know it's not as much fun sometimes, but the slower it goes, the less interest you're charged. And the faster it goes, the more interest you're charged. And so though I think that's a good analogy for kind of how that works. But you want to keep that both of those are important. Another way to look at it, the expected rate is the rate you want to look at before the loan closes. And the initial rate is the rate you want to look at after the loan closes, because that's the one that really impacts the amount you're going to eventually owe on the loan. However, like I said, if you're looking at that statement, and if that's you see in that loan balance getting bigger and bigger over time because your interest is adding on to the loan balance, if that statement, looking at that, is going to cause you more stress than the benefits you get from a reverse mortgage, you should not do a reverse mortgage loan, because you are using up some of the equity. Now, you might still be gaining more equity, but you're using some of it now for the convenience of not having a mortgage payment and improving cash flow, or getting additional cash for living expenses, fixing up your home, paying off debt, whatever you may be using that money for. Okay? And by having those benefits, it's easy to look at the statement and freak out and say, oh my goodness, look at this. This is bad. No, it's not, because you're keeping extra money in your pocket. Whether it's by having the money to be able to do what you want to do with, or using the money for some other purpose, it's to your benefit to do this. And if it's not to your benefit in your mind, don't do it. It's that simple. So you want to keep all that in mind. I also want to stress, though, if it's right for you now, if you qualify to get enough money to pay off your existing mortgage, and whether there's extra money left over or not, if it's right for you now, I say go for it now, because I will never forget the list of people that I talked to in 2022 when rates first started going up. Everybody was expecting the rates to drop the next year. Well, we all know what happened in 2023. They kept going up. And people that had enough money to pay off their existing mortgage at whatever the rate was, say 4% in 2022, they weren't 2% like they were in 2021, but they were 4%. Now, they didn't have enough money in 2023 to even pay off their existing mortgage, but they wanted to wait because they knew rates were going to come down in 2023. Don't be that person, okay? If it makes sense for you now, it makes sense for you now. The nice thing is you can refinance a reverse mortgage to access additional equity down the road. If you qualify for 40% of your home's value today, but that's enough to pay off your existing mortgage and improve your lifestyle, it makes sense for you to do it now. And then if rates drop, say next year sometime, you can then refinance at a lower rate to start with, a lower expected rate, and maybe access 50% of the value or 55%. So keep all that in mind. If you have any questions about anything we talked about, it's a little bit complicated today, but I'm glad you stuck with me. My name is Bruce Simmons. I'm the reverse mortgage manager with American Liberty Mortgage here in Denver. My number is 303-467-7821. 303-467-7821. That's my direct line. You can also visit me online at reversemortgageradio.net. reversemortgageradio.net is my website. You can go there and download my free consumer guide. The middle of next week, we'll have this podcast up on my website as well. You can listen to it, download it, whatever the case may be. But I look forward to talking to you when you're ready to learn more about reverse mortgages. Thanks so much for joining me today.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821, or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.